Hi, nice to meet you. Good noon. It's a pleasure to be here with such a diverse group of business professionals, students, and financial experts. The objective of today's session is to provide you with tools to analyze a company's financial statement in just 5 minutes. This high-level perspective is critical for informed decision making, whether you're evaluating the potential investment or understanding the core company's business model, or assessing the risk profile or financial stability of the company. To facilitate this, you've been provided key financial reports. If someone don't have, you can take from over here. These key financial reports extracting from audited reports of several companies. And first, please note, while we're using the real-world data, the company's names are anonymized and focused to pure on the numbers. Second, before we dive into the numbers, it's important to understanding where they came from. A comprehensive annual report consists of several sections: the business descriptions, the board of directors report, the certifications of internal control, also known as a Barnea report, and the consolidation financial statements, and the accompanying its notes. The notes, which often can span 100 of pages. To keep our analysis efficient, we have to distill this down to 5 primary statements: the balance sheet, the income statement, P&L, the statement of comprehensive income, the statement of change in equity, and the statement of cash flows. Now, what determined the way these numbers are presented? The answer is this conceptual framework. The conceptual framework is rooted by several fundamental principles: going concern and accrual basis. Going concern, the assumption is the company will continue to operate for foreseeable future. And the accrual basis, recognizing revenue and expenses when they are incurred, regardless the timing of the payment. To ensure this information is actionable, it must remain relevant, reliable, free from a material error, and comparable for different periods and companies. We start with the balance sheet. The balance sheet, following the auditor's report, provides a snapshot of assets and liabilities and equity. The fundamental equation is assets equal liabilities and equity, or in another way, assets minus liabilities equal equity. Please note that the equity is the accounting value of the company. Sometimes the value of companies that traded in stock exchange is different than this. Common items in assets like cash, inventory, goodwill, and liabilities like bank debt, bonds, account payable. However, the company's measure is not about just what it owns. It's about its liquidity. And this is where we look at the financial ratio, such as working capital, current ratio, quick ratio. Moving from the snapshot of balance sheet to the company's performance over time, we look at the income statement, P&L. This details revenue, cost of goods sold, operating expenses, financing, taxes, and leading to the net income of company. To get a true sense about company's ability, we focus in three key tools. The first, the gross profit margin. Gross profit margin is actually the production efficiency of the company. Second, EBITDA is metrics that neutralizes the effect of financing and accounting decision like depreciation and the taxes to provide us a clear view about the core operating performance of the company. And finally, benchmark. We must always evaluate this group against peers groups. Each sector has its own standard margin profit.